When you think about the characteristics of somebody who is a good investor, what you might be thinking is that somebody who is able to fundamentally value a company and pick up good opportunities, and maybe also they can spot and manage many different risks such as economic shocks or inflation or rising interest rates, knowing how to adjust their portfolios so it's not too impacted by any of those situations. While that kind of knowledge is very important, it is only half the battle. Investing is going to test your emotions and all of the different cognitive biases you didn't even know you had. So even if you have all of the right skills and knowledge, you can still end up being a poor investor if you leave your emotions get the better of you. A study has shown that 2/3 of investors regret impulsive investing decisions. When you think about it, the stock markets are full of emotion. Like, how often do we see panic selling when a slight bit of bad news comes out about a company? That was a clip from the New York Stock Exchange back in the 80s, which looked like complete madness. Even from that small little clip, you really get a sense for how much emotion was flying around the room. Investing has become a lot easier since then, and you don't have to ring up one of those kind of guys to try and get one of your trades sorted. But investing sitting at home on your mobile phone or your laptop can be just as emotional. So in today's video, I want to go through 6 different emotional and cognitive biases that you should be aware of. Once you are aware of these and know which ones affect you the most, it becomes a lot easier to actually control them. Try and make a mental note of how many of these that you are guilty of and leave me know in the comments. The first one up is loss aversion. So this is a trait of an investor who would prefer to completely avoid a loss rather than have an equivalent gain. If you are faced with a situation where you have to choose between either avoiding a €1,000 loss or avoiding a €1,000 profit, which one would you choose? If you chose to avoid the €1,000 loss, then you may have some loss aversion bias. I have a perfect example from my own investing. Back in April, I decided to buy 1.5 shares of Coinbase when it IPO'd. So I got in at a price of about $330 at the time. In the few weeks after the stock price plummeted, it dropped about 25 or 30%. My cognitive bias was telling me that this will eventually turn around. It's better for me to hold on to this stock rather than trying to sell it now at a loss. Well, now it's October and I'm still down 25%, and that's about a €93 loss that I have. What a smart investor would have done would be set up a stop loss at a price that you wouldn't be happy for the price to fall below. Before you go into an investment, you should really set up some sort of rules so you can try and take the emotion out of it. So if the price starts to rise, you know at what point you are going to take your profit, and if the trade goes against you, you also know when to cut your losses. What I did here with Coinbase stopped me from moving on to the next opportunity, where I could have easily made more than €93 to make up for the loss that I had made already on Coinbase. Next up is confirmation bias. Confirmation bias is when you ignore or filter out any information that is contrary to your own beliefs and prejudices. And in investing, this can be very dangerous. The best example of people with confirmation bias out there at the moment for me are Bitcoin maximalists. They label anything that is not Bitcoin a shitcoin, and there cannot possibly be anything else out there in the crypto world that is of any use. I sometimes also see myself falling into this trap as well. I really like anything to do with Cardano basically, and what I've seen lately is on my Twitter feed, for example, all I will see is only positive comments and Cardano fanboys. This is obviously from me liking and following only people who have the same views as me, whereas a good investor would take all different types of information and views into account. So it is important not to get completely blinkered. So what I have done to try and offset this is go and look for some negative commentary on any of the investments that I have made to see what the other viewpoints are and to try and balance out this bias. The gambler's fallacy occurs when an investor believes that a certain event is more or less likely to happen because of a recent sequence of events. This one may be more relevant to day traders, but let's say for example that you were day trading the S&P 500. And the S&P 500 ended up going down 4 days in a row. The gambler's fallacy in this case may make you believe that because the S&P 500 has been down 4 days in a row, that it is less likely that it's going to be down again for the 5th day. But in reality, this view is flawed because the events of the past do not change the probability of what's going to happen in the future. Next up, let's have a look at the herding instinct effect. So this probably applies to a lot of people who might go on the every word of what a certain finance YouTuber says. So this refers to a situation where people join groups or follow the actions of other people based on the assumption that that other person has done their complete research. It's easy to see on YouTube and other platforms where a lot of people have a significant amount of influence. You see a lot of private discords and things like this where people can see what kind of trades they are entering into and to try and copy them. But this kind of herd effect can really get out of control and actually cause market bubbles and crashes. The biggest example of this was probably the dot-com bubble, where people were just pumping money into anything that was online, even if they didn't even have any revenues, let alone any profits. Some other little common ones that you could see are Jim Cramer on CNBC. Whenever he talks about a certain stock, it might rise for a few days after he talks about it. This is known as the Cramer effect, so this is basically just a herding instinct. The best way to avoid this bias affecting you is to do your own due diligence and research. The next one on the list here is the endowment effect bias. This is where we as investors place too much value on any trade or investment that we already own. You believe that whatever you own has a higher market value than what it actually does have in reality. For example, you might own some Palantir stock or some Tesla and think it's worth 2 or 3x what the current share price is. But if you physically didn't own any of that stock, you might have a very different opinion on what the valuation is. The lesson for me from this one is to probably just not get too attached to your stocks. The last one I have to go through on the list here today is the normalcy bias. This bias is basically sticking to what you know and are comfortable with. In trading, this may mean a lack of ability to try and take on new ideas or to respond to some market signals which you have no experience with. The world and economic conditions change so rapidly these days that your strategy needs to also adapt along the way. As we have seen recently and earlier in the year, there has been rumours that we're going to see rises in interest rates, and that has a massive impact on the valuation of tech stocks, for example. So if you set up your portfolio 2 years ago, for example, and just decided I'm just going to go heavy in on just tech stocks and nothing else, I'm not going to change my strategy at all, it's probably gone very well for you up until now. But if you're not willing to change and adapt to new market conditions, you probably won't see the same level of performance. So that was just a couple of emotional and cognitive biases that you should be aware of. But I only really scratched the surface on things you need to know about in terms of your own emotions and trading. I'm actually going to leave a link below to an article in the description section that goes through a list of 50 different biases if you want to check them out. As I said, it is very good to try and be aware of these so you can try and actually just catch yourself out when you're trying to make a mistake because of some bias. So that's pretty much it for today's video. Thanks very much for watching. If anybody is new to the channel, please make sure to subscribe to keep up to date with my latest videos.